Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to this episode of Through the Noise. My name is Heung, a senior investment strategist with the CIO office. And very happy to be joined by Fook Hien, also a senior investment strategist in our CIO office for this weekly podcast. Now, there's continue to be quite a bit of optimism in the market, but we're also in the midst of a very macro-heavy weeks in the U.S. Powell obviously has gave us some hope about rate cuts after the surprise on the hot side of the PPI data, but we're still having some more data point to watch drumming up to the Fed FOMC meeting on September the 17th, including the jobs report, then PPI, and followed by CPI. So, Fook Hien, maybe as in this weekly, we're talking about Powell opening the door now for Feds to cut rates. Can you explain a little bit more about your view on the rate cuts and what is the investment strategy for it?
Yeah, thanks, Ray. After scaling record highs, I think global equities are looking for new drivers, and Fed Chair Powell gave investors a new reason to cheer. At Jackson Hole, Powell signaled the likely resumption of Fed rate cuts from September after a 9-month pause. Powell, he said that the balance of risk is shifting towards a cooling job market. U.S. rates adjusted for inflation, they are close to a 2-decade high, which are dragging down the rate-sensitive housing market and curbing investment. So while a 25 basis points Fed rate cut in September is highly likely, markets are pricing in an 88% probability now, the sustainability of a U.S. equity rally, it will depend significantly on the pace of rate cuts going forward. Money markets, they are pricing a total of 55 basis points of cuts this year, and a combined 138 basis points of cuts by the end of 2026. These expectations, of course, they will be tested when we get the U.S. job market report in the first week of September, followed by the inflation report at mid-September. So the Fed rate cuts are combined with the strong AI-driven corporate earnings, global fiscal easing, and fading trade tensions. These all should support global risk assets over the next 6 to 12 months. These positive drivers, they should overcome our near-term challenges. The near-term challenges include seasonal weakness in the next 2 months, the impact of U.S. tariffs on growth, stretched U.S. equity valuations, and a renewed political risk in France. For our investment strategy, we prefer the less expensive Asia ex-Japan equity markets within a diversified allocation, and especially we prefer the growth-oriented China offshore equity market.
Let's stay with the Fed for now. Lately, there are also headlines, quite abundant, including the most recent removal of the Fed Governor Cook. Are you worried about the Fed independence being challenged?
Yeah, I mean, President Trump's latest challenge to the Fed's independence through the firing of Fed Governor Cook, that will need to be closely watched. Cook has challenged this firing in court. And of course, the efforts to pack the Fed's decision-making committee with members who are seen to be willing to drastically cut rates, as Trump has demanded, it could potentially raise inflation expectations. It could upend bond markets. It could steepen the yield curve further and undermine confidence in the dollar and lift gold.
I see. So under these kind of political noises around the Fed's independence, what is the outlook in your view on the U.S. long-term bond yields?
Yeah, if you look at the US 30-year government bond yield, our view is that the yield would remain range-bound between 4.8 to 5.1%. The US 30-year government bond yield has remained in a narrow range of 4.8 to 4.9% throughout August. And this is retracing from around 5% in May and July. And even though a near-term inflation momentum was picking up. So recent comments from Powell reinforce expectations for rate cuts, which is supporting curve steepening as the front-end yields decline. But the US government bond supply, as well as concerns about the fiscal deficit and long term inflation, these are drivers of rising long term bond yields. The political noise surrounding Fed independence have further fueled this uncertainty. In the near term, we believe the U.S. Treasury they will issue more shorter dated bonds to alleviate pressure on long dated yields. So we expect the U.S. 30-year government bond yield to be range bound between 4.8 to 5.1%, and we would add to the long duration bonds if we see the yield spike towards 5.1%.
I see. Let us switch into equities now. Earlier, you also said that Fed rate cuts, the strong AI-driven corporate earnings should support the global risk sentiment. And what are the market implications of the recent earnings update in the U.S. semiconductor industry?
Yeah, so investment into AI infrastructure, it continues to support the US semiconductor and technology sector, although the sector may consolidate in the near term. So we see strong growth in US AI infrastructure spending. This supports the semiconductor industry, while your software companies are also benefiting from the demand to use AI tools for data analytics and to enhance productivity. This has led to US technology earnings growth expectations being revised up to 21.2% for 2025 versus estimates at 17.6% before the start of the Q2 earnings season. So strong earnings support, they will support our overweight view on the US technology sector. However, there has been limited sales of the advanced chips into China despite reports of a relaxation in US export rules. The Chinese government, they are also encouraging the usage of local chips in their AI systems. This has resulted in the US chip makers giving very conservative earnings guidance that excludes sales into China. Concurrently, a supply ramp, they also faces challenges with most of the advanced chips being produced largely in Taiwan alone. Hence, the sector may face near-term headwinds pending more clarity on sales into China.
Thank you. And you also mentioned earlier that we prefer the less expensive Asia ex-Japan equity markets. It's especially, I think, the China offshore market. Can you also explain a little bit more about the outlook for the China equity market in both onshore and offshore?
Yeah, sure. We are overweight. We remain overweight on China equities with a preference for offshore equities. Now, the rationale is that the China A share or the onshore market, it has shown strong momentum. We see the Shanghai Composite Index reaching a decade high and the total market capitalization of the A shares exceeding 100 trillion yen. Now, policy developments and market liquidity conditions are favorable here. We see the Chinese households, they are increasingly reallocating their savings into equities, while the elevated northbound capital flows, it also shows reasonable interest outside of mainland China. So efforts to curb excess capacity and price wars, it should improve corporate profits, with companies increasingly prioritizing shareholder returns over capex expansion. However, from a technical perspective, the onshore China market is overbought. Valuations in China onshore are also expensive versus its own history, with the 12-month forward PE trading at one standard deviation above its 5-year average. So we remain overweight on China equities, but we favor the offshore market, given the offshore has greater exposure to the technology sector. We see that the National Development and Reform Commission is accelerating the rollout of a 500 billion yen new financing policy tool announced in April, which is to support the emerging sectors such as the digital economy and AI.
Thank you, Fook Hien. Let's make a stop in Europe. In particular, I think about the political risk recently is agitating again in France. What is the outlook for Euro area equities amid this French political risk?
Yeah, so we would add to euro area equities on a pullback to key support levels such as 5,200 for the Euro Stocks 50 index. Political uncertainty is weighing on euro area equities, France, they are risking a collapse of the government after a confidence vote on the 8th of September. Earnings revision, they are also negative for the euro area, with consensus 2025 earnings growth estimates down to 2.2% now from 5.5% at the middle of the year. Now, the strong euro, it contributes to this earnings weakness because the euro area companies, they generate 57% of sales outside of the euro area. So a strong euro will translate overseas earnings into a smaller number. On the other hand, a stronger euro dollar would mean that the currency return enhances the performance of European assets held by a US dollar based investor. We see the region's valuation discount compared to global equities also being wider than the historical average. It is at 23% currently, and this discount should provide some support. Germany's fiscal plan to boost infrastructure and defense spending, and the European Commission's recognition of the need to increase defense spending. These are also multi-year fiscal headwinds. And as such, we see euro area equities as warranting a core allocation within a diversified equities portfolio.
Thank you, Fook Hien. Before I let you go, staying on the euro, maybe if you could give us a quick view on the currency in the coming weeks.
Yeah, sure. We expect the euro dollar to stabilize at 1.164. And then looking at the euro to the Swiss franc, we expect that to remain range bound with a bearish bias between 0.926 to 0.938.
Okay, thank you, Fook Hien. I think that's all the time we have for today's podcast, and thank you for listening in. Please stay tuned to our next episode on Through the Noise. Bye for now.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.